At first glance, European banking looks like an unbreachable fortress. Its walls are reinforced with record profits and rock-solid stability. But just beyond the moat, two huge digital tides are rising, and they're ready to crash against the old guard. And look, this isn't just about banks. This is really about the future of your money. So let's dive into the battle for the bank account.
So every year, the European Banking Authority gives the whole system a health check. And officially, the diagnosis is absolutely glowing. The sector is robust, it's profitable, it's stable. But you know what? These official numbers, they only tell half the story. Just beneath the surface, a massive shift is already underway.
Okay, so first, let's take a closer look at the walls of this fortress. By almost every traditional measure you can think of, Europe's banking sector looks like it's in an absolutely unassailable position. And this number right here is key, 16.3%. Now what that is the Common Equity Tier 1 capital ratio for European banks. In simple terms, think of it as a bank's core financial cushion, its ability to soak up unexpected losses. And right now, that cushion, it's at an all-time high.
And it's not just the capital. The official report paints a picture of near-perfect health. Profitability is soaring, bad loans are basically disappearing, and the cost of risk is minimal. And most importantly, retail deposits, that's your money and my money, they are still the solid foundation of their entire funding model.
The whole structure is built on one simple but really powerful concept, net interest margin, or NIM for short. It's the classic banking model, right? They take our deposits, they pay us a tiny bit of interest, and then they lend that exact same money out at a much, much higher rate. That difference? That's their core profit engine. Now, you're going to want to keep this concept in mind because it's the precise target of the disruption that's coming.
So you've got record capital, minimal risk, a stable funding base. It really seems like nothing could touch them. So what on earth could possibly go wrong? Well, it turns out the threat isn't just one single thing, but a two-pronged assault coming from completely different directions.
First, let's look at the external challenger. This is a force that's storming the gates from the world of digital assets, stablecoins.
Now, for anyone who's not familiar, a stablecoin is basically a digital token that's designed to hold a steady value. So unlike something like Bitcoin, it's pegged one-to-one with a real-world currency, like the dollar or the euro. The whole point is to be like digital cash, but without all that crazy volatility. And this market is just exploding. An analysis from Standard Chartered projects that the global stablecoin market could reach a staggering $2 trillion by 2028. That is a massive pool of digital money forming completely outside the traditional banking system. And here's where it becomes a direct threat to that fortress. That same analysis predicts that $500 billion of this growth will come directly from deposits leaving traditional banks in developed markets like Europe and the US. That is $500 billion just walking right out the door. As Jeff Kendrick from Standard Chartered puts it, when those deposits leave, the bank's funding base shrinks, and this directly squeezes their net interest margin, that profit engine we were just talking about. So this isn't just new competition, it's a fundamental attack on their entire business model.
But the attack isn't just coming from the outside. The second part of this pincer movement is actually coming from within the system itself, from the European Central Bank.
Say hello to the digital euro. This is a type of central bank digital currency, or a CBDC. The easiest way to think of it is as an official, government-backed digital version of euro cash. It wouldn't be held in a commercial bank account like Deutsche Bank, but directly with the European Central Bank itself.
And right here, you can see the central conflict. On one side, you have Wero, which is a new payment system launched by Europe's biggest banks to try and compete with giants like Visa and MasterCard. That's the private sector's big bet. On the other side, you have the digital euro, a public project from the ECB. The problem? Well, they're designed to do many of the same things, which sets them on a direct collision course.
And the banks are making their displeasure very, very clear. This quote from a joint statement pretty much says it all. From their point of view, the ECB is building a state-sponsored competitor that directly undermines their own multi-billion euro investment in Wero. In essence, they feel like they're being forced to compete against their own regulator.
So you've got this fortress of traditional banking caught in a squeeze. An external disruptor is pulling deposits out, while an internal disruptor is competing for the very same customers. And all this brings us to the most important question of all. Where is your money going to live in the future?
So these are your potential choices in this new landscape. You can stick with your traditional bank. It's familiar, it's insured, but it's clearly losing ground. You can move to a stablecoin, which is controlled by a private tech company and offers global programmable money,
but comes with some lingering regulatory questions. Or you could opt for the digital euro, a public, sovereign-backed option